Hello students, and welcome to Accounting 1115. In this video, we'll be going over Chapter 9, and in Chapter 9, we are going to be doing adjusting entries. So we will look at preparing an unadjusted trial balance, and we'll be looking at making adjusting entries for prepaid expenses, accrued expenses, unearned revenue, accrued revenue, and depreciation. Now we are going to be using the sample company provided by QuickBooks, which is your test drive company. So in this chapter, we're going to open up the sample company like you see here on the screen, so that we can practice doing these entries and test drive before performing them on your companies for your homework assignment. Basically, what is the purpose of this chapter? So prior to the creation of periodic financial statements, generally accepted accounting principles require that accounting records be adjusted to reflect accrual accounting. Okay, so this process ensures that the revenues are recorded in the period in which they're earned and expenses are recorded in the period in which they are consumed. So in the process, expenses will be matched in the same period to the revenues generated from incurring those expenses. Now, there are 5 types of adjusting entries. These are expenses paid prior to being consumed, which should be deferred. These are supplies, rent, insurance, etc., and recorded as assets. So that's just supply asset, prepaid rent, prepaid insurance, etc. And they are considered prepaid until they're consumed. So to defer means to postpone. So expenses incurred prior to being paid, such as payroll, rent, utilities, etc., must be recorded and accrued as a liability. So to accrue is to increase. So then revenue collected prior to being earned must be deferred. Sales, services, etc. And these are recorded as liabilities such as unearned revenue. And they are considered unearned revenue until they are quote unquote earned. Now revenue earned prior to being collected, again, sales and services, these must be recorded and accrued as a receivable. Now lastly, you have fixed assets such as your building, furniture, equipment, etc. And these are depreciated over time or over their useful life to match costs with revenue. And these are the types of adjusting entries we'll be doing in this chapter. So the first thing to do to get started is to do a trial balance. Now, this is something you guys have been doing pretty much this entire semester. You guys should be able to do this in your sleep by now. But just real quickly, how do we do a trial balance? Again, you're going to go into your company. So I'm using the sample company right now to kind of show you the steps. But when you go into your company, you're going to go to reports. All right. Now, I have told you guys in prior chapters, you could also create your trial balance as a favorite. So it may be up here already as a favorite. If it is not a big deal, you can come up here and just start typing in the name trial balance. All right, so it created a trial balance as of the date of this video. For the sake of what we're doing, we're going to do the previous month. So the previous month was actually March. So we're going to change the date to a March date. So I'm doing it 2 different ways to show you there's 2 different ways you can do it. You can just directly type in the month, or you can hit the calendar. So once we do that, you just go ahead and click Run Report. So what we did is we now created a trial balance as of March 31st. So we're currently in the month of April. If we're currently in the month of April, we're looking at the previous month. So we're going to look at March. And so this is going to tell us everything that's happened in March. Our balances as of March 31st, excuse me. It's going to show us all of our account balances as of March 31st. So if we go ahead and compare it to the figure in our textbook, it should match the figure in our textbook. That would be figure 9.1. Now, in further investigation of this trial balance that we now ran, and the period in business activity indicates that there's $500 of supplies that was recorded as a miscellaneous expense. So if we go down here, we do see that we have a record of miscellaneous. When we go to investigate what made up the balance, we realize that there was $500 of supplies that were reported as miscellaneous expense, and it should have been deferred as a supplies asset until consumed in the future periods. This is going to require our first adjusting entry. So to record adjusting entry for supplies in the sample company, we're going to actually do a journal entry. All right, so to do a journal entry, we just simply come over here to the plus new. We come down here and we find the option for journal entry. All right, we're going to use the last day of the month that we're looking at, which was March 31st. Now, we're going to go ahead and click on line 1. And what we're looking for in line 1 is we're looking for an account called supply asset. So we start typing in the word supply, and we see that the only account for supplies is the expense account. Now what we're doing is we're recording this as an asset. So supplies asset are supplies that are consumed during daily operations, and they're considered an asset until they are consumed. What does it mean when we say consumed? It means used. So in other words, if you have certain supplies that you use to create your product, or supplies that you use to provide your service, well, those supplies are considered an asset until you use them. Once you've used them in the act of a service or in the act of making a product, then it's no longer an asset, it becomes an expense because it's now been used, and it was used to generate revenue. What are expenses? Expenses is money spent to generate revenue. Simple as that. So now that I've explained that, we do not have in our chart of accounts right now a supply asset account. So we're going to have to create one. All right, so we're going to go ahead and type in supplies asset, and we're going to click add new. Now, first thing we're going to do is under account type, we're going to select other asset, because that's what it is. It is an asset. We're going to select other asset. And specifically, I want to select other current assets, because it is not just an asset, it's an actual current asset. So I want to select other current assets. For detail type, we're going to select probably something called prepaid expense right here. So it is an expense, it is a prepaid expense, because we are not expensing it yet. All right, we've already named it supplies asset, so we're not going to change anything there. So we're just going to, at this point, we can hit save and close. So what we're doing here real quickly is we're creating an account that is considered a current asset, and specifically the type of current asset we're creating is a prepaid expense. Okay, so now, again, it was $500 that was recorded as a miscellaneous expense that should have been recorded as a supply asset. So we're going to go ahead and debit 500. Now we're debiting supply asset because that's where it should have gone. It should have been a debit to supply asset instead of a debit to miscellaneous expense. So we're now adjusting it. So we're going to go ahead and debit the account that should have been debited. Now we're going to go down to the second line. And in the second line, we're going to select miscellaneous. So you can go ahead and start typing it in, and we see that miscellaneous expense account already exists. We know this because it's already posted to that. So we're going to go ahead and select that. Now, if you look here, it went ahead and auto posted the 500 into the credit. It's just a way of making sure that your debits and credits stay balanced at all times. So you should be able to look at your figure 9.3 in your textbook, and this should match figure 9.3 in your textbook. Once that is done, you can go ahead and click Save and Close. All right, so now when we go down, we see there are $500 listed as a supplies asset on our trial balance. And we've reduced it, should have reduced our miscellaneous expense right here by $500. Now, the same process can be used to defer a cost that's been recorded as an expense, but should be deferred as an asset at period ends. The examples may include an insurance to be deferred as either prepaid insurance or a prepaid expense, or rent to be deferred as either a prepaid rent or a prepaid expense. What does it mean when we say prepaid rent or prepaid expense? Prepaid rent and prepaid insurance are really the best examples. Insurance, 9 times out of 10, when you buy an insurance policy, you usually pay 6 months in advance. So you've already paid for 6 months worth of insurance coverage. Now you haven't received that coverage yet. You pay for it up front. That's why it's called a prepaid expense. So each month that you've received that coverage, it's no longer considered prepaid. It's now considered an expense. So you would actually take it from the prepaid expense account to the actual expense account. Same thing with rent. If you happen to prepay your rent, so you paid several months of rent up in advance, you would consider that a prepaid rent. And so each month that passes, you've now actually consumed that prepaid rent, and it is now not prepaid, but now paid. So another example of this occurs when an expense is deferred in a prior period, but is consumed in the current period. Okay, so we will use the supply asset created as an example, assuming that $100 of supplies were consumed in the month, leaving only $400 of supplies as an asset. So again, what we're doing here is, we talked about earlier how it's an asset until it's consumed. And what we mean by consumed means used. So we've actually used this supply now. We use the supply either to provide a service, or we used the supply to generate a product, but either way, it's now been used. So we need to update our journal entry. So it's no longer an asset, it's now an expense. So let's go up here to new again. We're going to click journal entry. We're going to type in the last day of the previous month. So they kept to the date. It remembered the date, so we didn't have to do that. That's really good. Now, what we're going to do is we're going to select, so we're going to type in the word supplies. All right, so I started typing the word supplies. Now we have 2 supply accounts. We have the supply expense account and the supply asset account. So again, what we're doing is we're actually removing it from the asset account, and we're going to record it as an expense because it's now been consumed. So expenses are always recorded with a debit entry. So we're going to choose the supply expense account. And we're going to debit $100 because that's how much of our supplies have been consumed. The next account we're going to hit is going to be the supply asset account. Why are we hitting that? Because it's no longer sitting there as an asset, it's now an expense. So we're going to credit that asset account, reducing the balance from 500 to 400 and moving it to the expense account, increasing the balance of our expense account by $100. When all is said and done, it should look like figure 9.4 in your textbook. When it's done, when you go ahead and hit save and close, and you look, it already populated the credit entry. I didn't have to type in $100 on the credit. So it populated it again for us. So hit save and close. All right, so now we can look at our supply asset balance has dropped to $400, and our supply expense account right here now has a balance of $100. So let's go up here. And let's actually click on the supply asset account. Let's see if we can do like a transaction report for the supply asset account. So let's go ahead and change the date. And run report. So here it shows that we had originally entered $500, and then we reduced it by $100, showing a total balance of $400. All right, so to go back to our original report, we would just come up here and click back to report summary, and that takes us back to the trial balance. Now, the first entry that we recorded deferred $500 from miscellaneous expense, and the second entry recorded the consumption of supplies, reducing the asset account by $100. Next, we're going to do an adjusting journal entry for accrued expenses. So again, we're looking at the trial balance, and upon further investigation of the trial balance, business activity indicates that a bill for $300 was received and recorded in the next month for advertising consumed in the current month. This is an adjusting journal entry and needs to be made to accrue this expense. So we will create a new accrued liabilities account to keep track of the accruals and then keep them separate from accounts payable. So to record an adjusting journal entry to record the accrual of advertising expenses, all right, we're going to have to go again, create a journal entry. So we'll click on the new and then come over here and click on journal entry. It should have remembered the last date, so we don't have to worry about dating. And if you also notice, it's keeping track of the journal number. We started with 1. We've done 2 journal entries, so now it's on number 3, so we don't have to update that. All right, so the first thing we're going to do is we're going to come down here to the account and we're going to type in the word advertising. Okay, so we're going to go ahead and select the advertising expense account. And let's go ahead and type in $300 in the debits side. Now, the next thing we're going to do is we're now going to type in the word accrued liabilities in line 2. Okay, so there is not an account for accrued liabilities. All right, so let's go back. I'm going to go ahead and put in my capitalizations. All right, and let's go ahead and click add new. All right, now the account type that we're going to use for this is going to become other current liabilities. So like the last one we used other current assets, well, this time we're creating a liability and it's a current liability. So we're going to create a current liability. The detail type that we're going to use is also going to be the same thing. Other current liability. All right, and we're going to keep the name accrued liabilities. All right, and then we hit save and close. It's auto-populated in the amount, $300 for credits column. So again, we should be able to look at figure 9.7 in our textbook, and it should match figure 9.7 in our textbook. Once that's satisfied, go ahead and hit save and close. Now, closing the journal entry should reveal that the trial balance created before now updated to reflect the accrual of the advertising expense. Okay, so what have we done here? So we have an accrued liability of $300 here. And if we scroll further down, we should see advertising now with a balance of $374.86. So we go back up here. We can actually click on the accrued liabilities for $300. Go ahead and adjust the date. And click Run Report. Okay, so we can see here that it should reveal the transaction where we created a journal entry to record the accrued liability. All right, and once we're done, we can click back, go back to Summary Report, and we're back to our trial balance. Now let's talk about unearned revenue. All right, so again, looking at the trial balance, we see business activity indicates that design income recorded on sales receipt 1003 for $337.50 to Dylan Solfrank were never performed, even though cash had been received. All right, the revenue, therefore, has not been earned. Work is expected to occur next month. All right, so this amount of revenue must be deferred and set up as unearned revenue liability. So what's happened is we have a situation of unearned revenue. We received income, but the service has not been provided yet. So until the service has been provided, we have not earned the revenue. So we have to actually record this income as unearned revenue. So in order to do this, again, we're going to have to do another journal entry. So we're going to go back to the plus sign and go here to create journal entry. All right, so it is not, we can't record it as income or revenue until it's been earned. So we're going to have to do an adjusting entry. So what we're going to do is take it out of the design income account. So we're going to start by typing in design income and type in the amount of $337.50. All right, the next line is going to be unearned revenue. So I'm going to start typing in unearned. All right. Now, unearned revenue, as you can see, does not currently exist. So we're going to have to click Add New to create the account. All right. So unearned revenue is considered a current liability. So for the account type and the detail type, we're going to select other current liabilities. We're going to do that for both of them. And once you've selected those, go ahead and hit Save and Close. All right, and of course, we see that it's already populated the 337 under the credits. Now, we're going to do a little extra over here. We're going to come down here and select Dylan Solfrank under the name category. All right, so by doing this, this let us know for what customer this unearned revenue is for. All right, so once we're done with that, we can go ahead and click Save and Close. And it should take us back to the trial balance again, where we can actually start looking, and we can see the unearned revenue right here that we just created. And we can actually come down here to design income and see that the balance reduced. Let's see here. There we go. So design income here is treated as a revenue account. So we basically reduced that income account and turned it and made it a liability because it's not considered earned yet. Again, why did we consider it unearned? Again, when you get paid for a service, before you do the service, that revenue is not earned. It's considered unearned. It's considered a liability at that point because you've now been paid in advance for something that you have not earned yet. Okay, so until we provide the service, it sits as a liability on our books. All right, so the next journal entry we're going to do for adjusting journal entries is called an accrued revenue. All right, so looking at the trial balance, it shows some landscaping services of $500 was performed on the last day of the month for Diego Rodriguez, but not invoiced. So here's the opposite situation. We have now performed the landscaping service, but we haven't gotten paid yet. We haven't gotten paid yet because we haven't really invoiced them yet. We just did the service, but we did it on the last day of the month in March. If you remember correctly, it's always important to record the revenue in the month of which it was earned. So we did perform the services on March 31st, but we had not had a chance to invoice the customer yet because before the month closed. But we still need to get the revenue on the books. So in this situation, it's accrued revenue. So since we've not invoiced the customer, we've also not recorded it into our accounting records. So we need to do an adjusting entry to the accrual revenue and accrue a receivable as well. So again, we're going to do this with a journal entry. All right, so the account that we want to create is a receivable. Okay, specifically accrued receivable. So we're going to type in the name accrued receivable. All right, so accrued receivable is not currently set up as an account, so we're going to have to click add new. All right, so an accrued receivable is a current asset. So for both the account type as well as should be able to select other current assets as well. There it is. Okay. So for account type and detail type, we're going to select other current assets because receivables are considered current assets. All right, so go ahead and hit save and close. And the amount that we'll be entering, the amount we'll be entering is $500. All right, now what is the account we're going to credit? Okay, so the account they have us crediting is a landscape services. All right, and this is a revenue account. They consider this a type of revenue income account. All right, so we're going, so what are we doing here? So again, let's recount what we're doing here. We provided the service, we've earned the revenue. Once you do that, you can record it to revenue. You can consider that revenue because you've earned it. It's not unearned revenue, it's earned revenue. So you can go ahead and record it directly to that revenue account. We haven't been paid for it yet. We haven't been paid for it yet because we haven't even had a chance to really invoice the customer yet because this literally happened on the last day of the month. We still got to get the revenue on the books for that month because we will make an accurate picture of revenue versus expenses for the month. So what do? We go ahead and credit our revenue account. So we credited landscaping services, which is set up as a revenue account. All right. But then we create a receivable. Now, for the receivable, we're going to go over here and we want to select which customer this is for, and it's for Diego Rodriguez. You got to always, so when you set up a receivable, you need to make sure you annotate somewhere on that journal entry who this receivable is for, which customer. All right, so in this situation, the customer is Diego Rodriguez. So we want to make sure we select Diego Rodriguez for this. All right, so Once you have that set up and it looks just like figure 9.9, you can go ahead and hit save and close. All right, so what we've done now is we have created a receivable. I'm going to click on it. We can change the date. And click run report, and that'll give us the transaction details for that receivable. All right, and go ahead, now we can just go ahead and click back to summary report, and it should bring us back to the trial balance. All right, so I believe the last adjusting entry we're going to do is one to record depreciation. All right, so when a company has a fixed asset, and a fixed asset could be property, plant, equipment, okay? Specifically property, plant, or equipment used to generate revenue, not investment property, but actual property, plant, or equipment that is currently being used to generate revenue. So specifically focusing on equipment, items like equipment, vehicles, etc., they depreciate over time. All right, so depreciation is recorded as a contra asset account as well as an expense account, and that depreciation is usually recorded on a monthly basis. The amount that is depreciated is based on the useful life of the asset that is being depreciated. So for the example in the book, the company's only fixed asset, which is a truck, needs to be depreciated for the month. So they have the monthly depreciation recorded as $1,000. So then this is normally the adjusting entry would debit depreciation expense and credit accumulated depreciation, and accumulated depreciation is your contra asset account. However, the accounts set up in the sample company are both named depreciation. So you have to decide to change the names first and then record the depreciation adjusting journal entry. So how do we do this? All right. So first thing we're going to do is we're going to go to our chart of accounts. It has it doing a different way in the books. So it has you going to the gear icon, chart of accounts, see your chart of accounts. Okay, so we see our chart of accounts. All right, so we need to look for depreciation. So we can scroll and look for a depreciation. So here we see an account called depreciation. It is named depreciation. So we're going to click on the drop-down menu beside the view register, and this is how you can change the name of one of your accounts in your chart of accounts. Okay, so you go over here, you find the account, and we see that it was named depreciation. So we have an expense account named depreciation, and then we have a contra asset account named depreciation. So we need to edit it. So what we're going to do is we're going to edit the contra asset account named depreciation, and what we're going to do is we're going to name it the correct name, which is accumulated. Okay, so that is the name. So once that's done, we can hit save and close. So now what we've done is we've changed the name of that account. So now, so it's both under fixed assets, but we have accumulative depreciation. All right, so now that that's done, Let's look for the other one that says depreciation for, let's see here, miscellaneous, so we can find that one. All right. I just love it when these things pop up. All right, I had to get rid of that window that decided to pop up. All right, so what we're gonna do here is we're gonna do the same thing. Next to where it says run report, we're gonna hit the drop down arrow and select edit. All right, and what we're gonna do here is we're just gonna add the word expense after the word depreciation. So, and that's all we're gonna do there, and then hit save and close. All right, so now that we've renamed those accounts, now that was important to kind of learn how to do. So in case the chart of accounts you're working at in your company has the same issue, same situation, you know, I want you to be able to know how you can go in and modify and change the name of your accounts so it's not so confusing when you do your adjusting journal entries. And the accounts you may or may not need to add for your companies may or may not be the same accounts we've had to add in our sample company. But what I want you to understand is that your instructions will tell you which accounts to select. And if you don't have those accounts, you will follow the same steps that we are doing in this video to add those accounts to your chart of accounts. All right, so now what we're ready to do our journal entry. So we'll go back to click on new and click on journal entry. We're going to continue using the last day of the previous month. All right, so now what we're going to do is we're going to record the depreciation. So what we're doing here is we're expensing out the depreciation. All right, so what's happened is you have an asset that had an original value of $40,000, and every month the value of that asset decreases by $1,000 because it has depreciated in value by $1,000. So you expense that depreciation. So the first thing we're going to do is come over here and we're going to select our depreciation expense account. So there's our depreciation expense account. All right, we're going to type in the amount of $1,000. All right, now what do we credit? So what we're crediting is our accumulative depreciation right here. All right, so what is this account? This account is called a Contra asset account. And this account shows up on the balance sheet under the assets, the fixed assets. So you would list truck. So when you're listing all your fixed assets on your balance sheet, one of the fixed assets you would have listed is your truck. And that truck is listed at its original value of $40,000. Underneath that will have your accumulative depreciation, and it'll have the amount as a negative number, whether a minus sign or a parentheses underneath it for the total amount is depreciated at this time. And what it does is it actually reduces the asset value by the amount it's depreciated. That's why it's called a contra asset. It's listed as under the assets on your balance sheet, but it's meant to reduce the value of that asset based on the amount it's depreciated. All right, so once we've entered accumulative depreciation, you should be able to look at figure 9.10. It should match showing 9.10. If it looks good, then you're going to go ahead and hit save and close. All right, so now we're going to go back to reports and we're going to run another trial balance. All right, change the dates. And click run report. All right, so we should be able to see our accounts. So right there, we see our depreciation expense of $1,000 where we have expensed it out. And we should be able to see the original cost of our truck. And the original cost of the truck here was $13,495. And you can see it's a credit, which means it's reducing it, the accumulated depreciation for the truck for $1,000. So that is it. We just recorded adjusting entries to create accrual accounting based records. In the next chapter, we will create financial statements and useful reports. But that is it for this chapter. So hopefully you'll be able to watch this video and kind of follow along in your textbook. And I encourage you to go into the test drive yourself and play around and get comfortable doing these steps before starting your homework, because you will have similar problems in your homework assignments. And again, if you have any questions or concerns, feel free to email me.